Welcome to Multibagger Shares, value investing education for 200 million Indian investors. I'm Manish Goel, and today we are going to learn about one of the most powerful yet underrated metrics in stock analysis, the cash conversion cycle, or CCC. Before we begin, let me ask you a question. If a company reports 50% revenue growth and 40% profit growth, does that automatically make it a great investment? Most investors would say yes. But experienced value investors know better. The real question is, where is the cash? A company can show impressive profits on paper but still be cash-starved. How? Because its money is trapped. Trapped in unsold inventory sitting in warehouses. Trapped in accounts receivable because customers haven't paid yet. Or consumed by inefficient operations. The cash conversion cycle reveals exactly this. So what is the cash conversion cycle? It's a metric that measures how many days it takes for a company to convert its investments in inventory and other resources into actual cash from sales. The formula is simple. CCC equals DIO plus DSO minus DPO. Let me explain each component. DIO stands for Days Inventory Outstanding. This tells you how many days inventory sits in the warehouse before being sold. If a company has a DIO of 90 days, that means on average, products sit for 3 months before anyone buys them. That's cash locked up doing nothing. DSO stands for Days Sales Outstanding. This measures how many days it takes to collect payment from customers after making a sale. In India, many companies sell on credit, especially to government entities or large corporations. If DSO is 120 days, that's 4 months of revenue sitting as receivables. Very dangerous. DPO stands for Days Payable Outstanding. This is how long the company takes to pay its own suppliers. A higher DPO actually helps, because the company is using the supplier's money as interest-free financing. Now, the magic happens when you combine these three. A shorter total CCC means the company converts investments into cash faster. And here's the gold standard. A negative CCC. This means the company collects money from customers before it pays its suppliers. Companies like Hindustan Unilever achieve this. They sell products that move off shelves immediately. Consumers pay at the store. And HUL negotiates extended payment terms with suppliers. That's working capital mastery. Let me give you a real example. Imagine you're analyzing a specialty chemicals company. Average inventory is 50 crore rupees. Cost of goods sold is 200 crores. Average receivables are 40 crores. Revenue is 300 crores. And average payables are 30 crores. DIO equals 50 divided by 200 times 365. Which is about 91 days. DSO equals 40 divided by 300 times 365. Which is about 49 days. DPO equals 30 divided by 200 times 365. Which is about 55 days. So the CCC equals 91 plus 49 minus 55. Which is 85 days. For a chemicals company, this is in the acceptable range. But you'd want to track this over 5 years to see if it's improving or deteriorating. Now, why does this matter for finding multibagger stocks in India? Let me share 5 critical rules. Rule number 1. Always compare CCC within the same industry. A CCC of 90 days is terrible for an FMCG company but perfectly normal for a heavy engineering firm. You must benchmark against peers, not across sectors. Rule number 2. Track the trend over 5 or more years. 1 year CCC is meaningless in isolation. What matters is the direction. Is it getting shorter year after year? That's a sign of improving management quality. Is it getting longer? That could be a warning sign. Rule number 3. Watch for the deadly combination. Revenue growth plus CCC deterioration. If a company is growing sales by 20% but its CCC has stretched from 60 days to 120 days, be very careful. This often means the company is pushing sales by offering generous credit terms or stuffing distribution channels. This kind of artificial growth always unravels. Rule number 4. A negative CCC is a competitive moat. When a company consistently operates with a negative cash conversion cycle, it has a structural advantage. It's essentially using other people's money to grow. This advantage compounds over decades. Rule number 5. Combine CCC with free cash flow analysis. If CCC is improving, free cash flow should also be improving. If they diverge, CCC improving but free cash flow declining, something else is consuming cash. Perhaps heavy capital expenditures or acquisitions. Dig deeper. Let me talk about Titan Biotech as a case study. Titan Biotech Limited, BSE code 524717, is currently trading around 368 rupees. The company recently reported Q3 results with net profit jumping 94% year-over-year to 8.53 crores. This kind of profit growth, combined with strong operational efficiency, is exactly what we look for when analyzing any company, including Titan Biotech. Looking at the cash conversion cycle alongside traditional metrics like ROCE, free cash flow, and earnings growth gives you a complete picture. It's this kind of thorough fundamental analysis that helped us identify Titan Biotech at around 130 rupees. And here's what frustrates me. While quality-focused investors were building wealth through fundamental analysis, SEBI's own study confirms that 91% of individual traders in the F&O segment lost money in free 2024-25. The total losses, over 1,05,000 crores. That's wealth destroyed by speculation. Today, March 27, 2026, with the Sensex down over 1,000 points to around 74,244 and the Nifty below 23,000 due to US-Iran tensions, the market is volatile. But remember, companies with efficient cash conversion cycles weather storms better because they generate their own cash and don't depend on external financing. So my message to all 200 million Indian stock market investors: learn fundamental analysis, understand metrics like the cash conversion cycle, invest in quality businesses with proven management, strong cash generation, and efficient operations. And please, stay away from F&O gambling. To summarize today's lesson, the cash conversion cycle equals days inventory outstanding plus days sales outstanding minus days payable outstanding. A shorter CCC means faster cash generation. A negative CCC is the gold standard. Track it over 5 years and compare within the same industry. Rising revenue with rising CCC is a red flag. Thank you for watching. If you found this valuable, please subscribe to our channel and share this with fellow investors. Together, we are building the largest community of educated value investors in India. For more lessons, check out our complete value investing course playlist in the description below. This is Manish Goel from Multibagger Shares, signing off. Happy investing.